All right, good evening. So we're going to be reviewing the PM session for today's trading, which is the 13th of February 2025. All right. So we're going to be covering a market maker model that was predetermined hours before the execution and before the trade formation. All right. So we're not covering the morning session because I was preoccupied doing the morning session and I came doing this rally. So I couldn't jump inside of price because I've seen this sell side liquidity pool. This low here, it was seen as sell side liquidity pool as indicated here. I'm leaving all of this here because this was what, so I did all of this insight here, understanding why price shouldn't invalidate this 1, 2, and 3 PDRA, which is the equilibrium, the consequent encroachment. This is me using consequent encroachment as my entry criteria and my stops placement in counting the 3 PDRAs I would not want to see being violated. So this was the first one, the midpoint of this other block. So that was the first one. You had the second one here. This there's an imbalance here on on this downside on the CB, and on this CB here you have an imbalance here. So the midpoint of all of this is they are all consequent encroachment acting as a support, a true support, preventing price from going lower. This gave us the premise for going into the PM session. Now, when we came to the marketplace here, all of this was done live. I came late because I was preoccupied with some personal errands. Now, in coming to price at this time around 10:30, I anticipated the algorithm leaving a high before the close or before the 11 a.m. session. So I indicated this all of this um, notes was done during the morning session, going to the close of the morning session for New York trading. Now, this was indicated. If I'm the market maker, let's make this bold. Now, if I am the market maker, I will make a false stop in the market pre 11 a.m. Now, what does this mean? What does this entail? Now, because the market is making new highs currently, the market is currently making highs. Traders, they will try to pick tops. So this is why you should not try to pick tops in a bull market or try to pick bottoms in a bear market. You should ride with the flow, or you wait for the algorithm to give you a clear one-sided direction in price before you tend to do anything. Now, in coming here late, when you are trading, you should describe yourself as the market maker, not a market maker. There's only one market maker, which is the central bank, which uses the interbank price delivering algorithm for its delivering of price. Now, you indicate and describe yourself as the market maker because this will give you a sense of control over the market. Now, you are not trying to control the market, you are trying to control yourself, your engagement in price action, how you execute, and how you see a body of price action. Now, but you giving yourself that identity, that alter ego of you being the market maker, gives you that sense of absolute control over your actions while trading. Now, buy side liquidity was indicated there, and at 11:12 a.m., price came to this high, making these relative equal highs here. As you can see, the algorithm sees these relative equal highs as where traders will place their stop. Now, why you should indicate yourself as the market maker is because you're going to see the other side of the failed logic, of the false logic. I mean, what do I mean by that? Now, because we've been programmed The general public has been programmed to see the market in a different aspect in the idea of supply and demand, or a clean level of support and resistance, which is a false narrative, which is misinformation. Now, this misinformation, the algorithm understands that this is what a lot of traders, this is their idea of how the market books price with that false knowledge. That's what the general public thinks. But now, because the algorithm knows this and the market maker, in fact, knows this, it understands that the fraud logic states that when you have double tops like this is a support, this is a resistance level, meaning this cannot be pierced, meaning traders will place buy stops above this price level, which is 6091.8. Now they'll place their buy stops here. Now, as traders, you'd want to know where price is likely to go first before you think where the entry is likely to form, or where the pairing of liquidity on the opposite side of the market is likely to form next. So after indicating this right here as our buy side liquidity, we understood that during the PM session, the algorithm will make use of this buy side liquidity as the draw on liquidity, acting as a magnet, drawing price for higher prices. Now, you've understood where the draw on liquidity is, where price is likely to draw to next during the PM session. Now, where do you expect a pairing of liquidity to take place in the opposite side of the market? Because the market efficiency paradigm states that for a market to be efficiently delivered, it must offer both sell side liquidity slash delivery and buy side liquidity slash buy side delivery. Now, at 10:27 a.m., a few traders that entered from this 9:30 open, around this 9:30, they bought this low and ultimately this low. They would have traced their stop losses to this low and this low. Now, because we're expecting a purge of sell side liquidity and a sweep of buy side liquidity, we're not expecting price to further purge lower to far discounted PDRAs. Now, then then I wrote this after writing this. This was the first narrative, and this was the follow-up narrative. Then, if I'm the market maker, I will bring price lower to an engineered sell side liquidity. Where is the clearest engineer? The first engineered sell side liquidity pre 11 a.m. before the launch session. The sell side liquidity is this low here. So this low was indicated and drawn out in time. This right here is an engineered sell side liquidity, because the market cannot be just going higher in a one-sided direction. That will collapse the market. The market must offer an engineered liquidity on a sell side to for smart money to use that as a counterparty for their buy orders. So that is it. Because that's basically what the algorithm does. Pairs up buy pairs up sell stops and deliver it to buy stops. Now, furthermore, going into the at 1 a.m., price started meandering around here. Then we had this drop lower. Price purged this sell side liquidity. This was our first indication that price is now likely to seek buy side liquidity. Now, if you're trading a total soup entry deal, this will be your entry model, and your stop placement will be below these three PDRAs. Stop placement will be below here, like this. And as you can see, price didn't come for the low of this imbalance. All of these imbalances, this is your assignment. You should go to the 1 minute time frame and look for these imbalances here and draw all of these out in time to the right side of your chart. All right, let me just show you what you have to do just with this extend right. So you have to do this. See how the midpoint of this is being respected and price is failing to trade lower, because for price to trade lower, this will invalidate the idea. There's something here also I would want you to study it for yourself. I would not want to deprive you of that knowledge. There's something here. Why price traded just to the midpoint of it, trading shy lower to the into the below the equilibrium, below the consequent encroachment of this imbalance. So look for that. That is your assignment. We're going to cover that in the Telegram channel. Now, furthermore, when we had this drop lower in price, price rallied higher. This rally higher, this expansion leg higher, this one the 124 p.m. candle. This is the algorithm tipping its hand to us that are in the know of this narrative that was gotten here during the 10 a.m. to the 11 a.m. window. There was a narrative gotten here. That narrative is going to be in play going into the PM session. Now, when we had this expansion leg higher, instantly we understood that the algorithm is tipping its hand towards that price is in fact coming for buy side liquidity, because as you can see, we had a body close above this highest body's close, which is establishing a shift in market structure. Market structure is shifting from a short-term buy sell program to a buy program, and it is happening within the a PM session reference. Now, when you have this rally higher, this last down close candle, you draw that out in time. That is your bearish order block. Sorry, that is your bullish order block. A down close candle like this that purged liquidity. It is a bullish order block. Now, we're going to take the close of this candle and low of the candle, and then an order block like this that has this week, you also indicate the midpoint of the week. The midpoint of the week is of significance when you have a long week like this. So this is a discounted PDRA. The other block, the opening of the other block, the close of the other block, the because it is of a long week, you make use of the week also in framing your buyers. Now, at 1:30 a.m., 1:30 sorry, at 1:30 p.m., 1:30 is the true opening time for the indices market. 1:30 p.m. Now, meaning when all of this is taking place, you are not concerned with any of this. You are waiting. You are only using them as reference points to understand the algorithm tipping its hand to you in what order flow is telling you and what order flow is being established by the algorithm. Now, when you add this rally higher, price left an imbalance here, coupled with this order block. This is signifying to you higher probability setups. Now, if you look to your left hand side at this candle, I would advise, as you are currently watching this video, you have a you have your chart open so that you can be seeing this for yourself. But if you do not have the luxury of watching this video and also having your chart open, you you are advised to indicate all of this. Just take a screenshot of this, and later you look at it and you study it for yourself so that the knowledge becomes ingrained in you. Now, if you take a look at this 12 a.m. candle, this 12 p.m. candle, sorry, you have this imbalance here resting in this price action. So it is of interest because you have price reacting from it here, using it as a short-term support, rallying higher to take out this high, take out this high, then ultimately this relative equal highs here, this closely relative equal highs here. Now, this is the algorithm telling you that this PDRA here, it is of significance. So you draw that out in time. All of our PDRAs, they are always fresh PDRAs. There's nothing coming from um a previous. There's no PDRA here that cannot be reused into the future. So you should most times leave your PDRAs in your in a body in that your body of price action while you are still, especially when you are still learning. Now, if you go further to your left hand side at this 12 candle, we left this discount week and also this week. When you have two closely related long weeks like this, you look for the midpoint of this week and the midpoint of this week. This is your gray pool. You draw that out in time. Now you can see how the algorithm is using this. Now, remember the support and resistance logic we got from the flood idea. Now, because the support and resistance logic from the flood misinformation that was passed around to the general public, it's it looks at a support and resistance level as, for example, something like this. It shouldn't be violated. This high now, this is a resistance level, so meaning it shouldn't be violated. Now, because this is a flawed logic, the actual support and resistance is using PDRAs. These algorithmic signatures. PDRAs are algorithmic signatures that appear in price because price is public. Price is public knowledge, meaning they cannot they cannot twist price. At On Thursday at 12:45 p.m. on the 3rd of February 2025, the price of the S&P was here. So we had this high here. Look at this candle. Look at here. This one I'm drawing your attention to. It is six, 60, sorry, 6,086.7. This was the high. Now, because this is the CFD, this is each CFD, each broker will have its own um price delivery, but there will be at least similar. If you're trading the S&P or the Nasdaq, the E-mini, you will have a clear and unified price in all of the market. So they are all unified prices, unlike the forex market. And even though the forex market are not unified prices, their price movements and their settings, they are almost identical, if not identical. Now, back to the topic of discussion. So, price rallied higher, leaves this imbalance here. This draw out in time. This is your this is currently below the 130 opening. Now, to understand what we are doing here and how we got this 130 opening, to use that as a narrative for the execution, buying low and offloading at a higher price. So you have a candle. This is the skeleton of a candle. So previously, one of the style of how candle formation is like this. So you have the opening price. Price opens here, and then for a bullish candle, price you have a drop lower below the opening price. Now this is accumulation. This is accumulation of long position, and also it engineers liquidity on both sides of the market, on the buy side and also on the sell side. Now, when the move is almost ready to go, we have a drop in price. Price will drop lower to create a cheaper market for smart money. Now, this cheaper market for smart money will fill in their buy position when the candle drops lower to offload at a higher price. Now, they do not know where the high is going to be, where the final top is going to be, and they do not care because that is irrelevant. You want to skim the most of the portion, most of the expansion leg higher. That is where you want to take most of your position off. So when you have this drop lower below the 130 opening, now assuming this horizontal box here, this horizontal rectangle is the opening price. This is 130, and then price drop lower. Then we had this rally higher. Does that make sense? We do not care where it is going to close. We only care about the the opening, the low. When it goes for the low, you find PDRAs that works with your personality or your model, and you enter your position here, either a single position or pyramidal positions. Then during this rally, you take partials off, or if you are trading a one short one Q entry, you buy below the 130 open and just take out your position above the buy side liquidity. And then finally, ultimately, we have a close. Yeah. So this is generally how you have a bullish candle looks. This video has gotten longer than I intended, but that's what you get for staying this long. You get free value. So price opened here at 1:30 p.m. and then rallied higher, engineering buy side liquidity and sell side liquidity. After this rally higher, price engineered buy side liquidity, sell side liquidity. Then at 1:42 p.m., price dropped lower below the 130 opening. But as you can see, the bodies of all of these candles are respecting these PDRAs, this first PDRA, this second PDRA, and this breaker. This is a bullish breaker. I didn't get this on the live, but this is a bullish breaker. Yeah, this price going higher. So the traders that traded this by this short term rally higher, they'll place their stop losses below these lows, and the price will drop lower, breaking their will, breaking every form of hope they have in going into the market for higher prices. Now, when you have this drop lower, their will be broken and they will not have the conscience or the heart to go back into the market for their intended correct directional buyers, because they are correct in their directional buyers expecting higher prices, but they are wrong in their timing of the market. Time. Time is of the essence. Time is extremely important in algorithmic theory, in every algorithmic theory, not just the market. But that's by the way. So price drops lower into this PDRA, feel this imbalance here, drop to the imbalance. Also, you have this other block here. You draw this other block out in time, find the midpoint of the other block, you draw that out in time. Now you want to see price rejecting and not wanting to stay too long below these PDRAs. This is further signifying to you of a bullishness in price. So you place your entry position here, your stop loss below this candle here, preferably your stop loss below here, because we've rebalanced here and price has nothing to do here below here ever again. So you are at 1:42 p.m. Price drops lower to the midpoint of this other block, which is valid for the best buys forms above the midpoint of a PDRA. This week on its own is a PDRA. So you have these buys forming above it here. Price rallies higher further once more and then creates this imbalance here. Price creates this imbalance and we get to fill this imbalance once more and then rallied higher, coming for these highs that was left pre 11 a.m. Price keeps on rallying higher, and so you have all of these price action. So that is that for the PM session. I'll talk to you tomorrow, being Friday, or I might be preoccupied for tomorrow. So probably Saturday, or if we don't get to speak on Saturday, it will be till the next week, being Monday. So hope you've got something from this video. Have a nice day and good luck, good trading.